Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, October 14th, 2023. How's everybody doing? I hope you had a good week. I appreciate you coming here to the podcast, and hopefully you'll learn something good today and that it's going to be valuable for you. What we're going to do today in this podcast, in my weekend review, we're going to talk about all the different trades that I took last week. We're going to talk about when I bought them, why I bought them, which strategy I used, what setup I used, and then most importantly, how I am going to manage the trade going forward. Whether the market I'm trading is going up or going down, I have a lot of rules that tell me to either stay in, get out, take partial profits, and that's what I'll explain hopefully today as we go through the trades. When I'm trading in general, what I'm looking for is I am looking for a level to be rejected, a key level like the 30 RSI, the 200-day moving average, the 250, the 300, if I'm looking for a deep dip buy. And I'm looking for the market to tell me that there are no more sellers below that level. Then I need to position size correctly based upon the volatility, which is very important. A lot of traders don't do this, but sometimes the market's volatile. It would be expected to move a lot more one way or the other, or it's less volatile, that it's going to move less either up or down. And you need to position size correctly based upon the volatility, and I will show you how to do that. And the market is volatile right now, so in general, you are going to be wanting to buy fewer shares because the anticipated move is going to be larger. If you have a large position size and it moves your way in a volatile market, then that's great. But if it moves against you, that's not so great, not so hot tamale, as I like to say. So it's important that you position size correctly based upon the current market volatility. So after you've looked at a level that's being rejected and you position size correctly based upon volatility, then the way that I do it, I have two stops. I have an end of day stop, which if I'm doing my job right is going to be very close to my end of day stop. And so if I'm wrong, I can be wrong small. And then of course, I always place an emergency stop 2 ATRs below my entry if I'm long, so that I know what my maximum allowed loss is going to be on any one trade. Now, if the market that I'm trading starts moving up the value of 0.45 ATRs from the previous day's close, I always take a little profit. I always like to take partial profits when the market gives them to me. That accomplishes two things. It helps me lock in partial profits that the market can't take away from me, and it also reduces my risk because now I have fewer shares. That is an offensive move in trading. The defensive move is position sizing correctly, having that end of day stop, having that emergency stop. The offensive part is taking partial profits when the market gives them to me. Then if we get to a 1.5 ATR trailing stop level, then if I have a close below a previous bar's close after reaching that level, then I'm going to take off half, depending on the strategy that I'm using. But that's also a defensive part. And, before we get started, I would like to say as well that large wins are obviously completely acceptable in trading. Small wins also acceptable. Even break even trades are acceptable. Small losses are acceptable, and you're going to have a lot of those. But what you really need to stay away from are the large losses. Those are the ones that will destabilize your account financially and also destabilize you psychologically and mentally. So, trading is not an easy thing. It can be super, super easy, or it can be super difficult. It depends what mindset that you're in. But you need to keep away from those large losses. And hopefully what I will teach you today will show you how to do that. And one last thing before we get started, we need to be very impatient with our losers. Very impatient. And we need to be very patient with our winners and have a process that lets us be patient. That is the way that you become a profitable trader, is being very impatient with your losers, very patient with your winners. So we'll go through all the trades that I had last week, and you will see that I've had some double-digit gains on some positions. I've had some break-even trades. I've had some small losses. But what you're not going to see is a large loss. Did I say small losses? Yeah, large wins. You're going to see some large wins. You're going to see some small wins. You're going to see some break-even trades. You're going to see some small losses. But what you're not going to see are any large losses. And that is the key. Okay, so we'll go over all the trades. This is what you're going to see. After that, I'm going to talk a little bit about trader psychology and some good trading words of wisdom. And hopefully that is going to be helpful for you. You know, we always talk about skill in trading. What the number one skill in trading really comes down to your ability to follow your process. That's what you need. You need to have a process, and then you need to be able to follow it. Doesn't matter if you have the greatest process in the world. If you don't follow it, you know, then it's all for naught. So you need to get yourself a good process. And by the way, I do teach private one-on-one lessons in the evening time via Skype. I have a 15-hour course that I teach one-on-one. I teach you all 5 of the different trading approaches that I use. I teach you step by step, and everything I would teach you is proper trading techniques. Everything that you need to become a long-term profitable trader. So if you are interested, my email is the link of the description. Just reach out to me and we can start a conversation. I've taught many people from all over the world, from absolute beginners to hedge fund managers. So if you're looking for a good coach, if you're looking for a good process, I definitely provide that. So just get in contact with me. All right. And then after the trader psychology section, we are going to go down. I have gone down through my master watch list, and I have looked for some potential trades for next week, both on the daily and the weekly charts. They are not where they need to be yet. If they were, I would have most likely already taken the trade. But it's very important on the weekends for me, and I think it's good advice for you as well, is take a look at your charts on the weekends. Identify a good level that you would be interested in getting in the trade at, and when the next week comes, don't get in unless it rejects that level. And that's what I'm going to show you here, both on the daily and the weekly. All right, so with that, I need to run the U.S. legal disclaimer first, and then we will get started. So hang tight. It takes about 40 seconds, 42 seconds, something like that. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started on some of the daily trades that I took last week. All right, we'll start with the open trades first. So this is AMD, Advanced Micro Devices. I bought this back here on the 25th of September. So that was quite a long time ago. So what does that tell you? If I've been in this since September 25th, it means that this is a positive trade. There's no way I would be staying in this trade so long if it were negative. I mean, a lot of the trades I have, losing trades I have, I'm in for one day. I'm in, oh, if it goes against me, boom, I'm out. That's me being very impatient with my losers, and because I've been in this trade so long, I'm being very patient because it's a winning trade. Make sense? So, all right, here we go. Why did I enter this trade? Well, you see the black line here. This is the 200-day moving average. This is a key level that large financial institutions and savvy traders will look for. Well, I bought this on the 25th because during the day, it went below the 200-day, but it closed above it. And I base all of my trades on the closing of the bar, whether it's a daily or a weekly. Because the close of the bar, in this case on the daily, the large financial institutions come in at the end of the day. That's when they take over. I believe they're the smartest group of traders. They're dealing with most money. They have the best technology. They have very, very smart people. And so the closing price is the most important. So I wait, whether I'm day trading on a 5-minute bar or whether I'm trading dailies or weeklies, I wait for the close of the bar. So I entered here. You can see during the day it closed below it went below the 200, but closed above. It also had a V1 trigger. Bar 1, bar 2. Do you see how we went below the low of bar 1 and then we closed above the close of bar 1? So this is, I wouldn't take the trade just based upon the V1, but it does add value. You know, and if you've listened to this podcast for a while, you've heard me say many, many times that I want to take the trade that has the most combinations and confluences of signals. The main signal is that we intraday rejected the 200-day, but this trade got bonus points because it had a V1. There's also something called a V2. And if you'd like to learn more about V1s, V2s, just go to my YouTube channel and in the lessons playlist, and you'll see V1, V2 entries. They're really a big part of my trading. They're not that hard to figure out. And in that video on YouTube, I go through kind of step by step what a V1 and V2 is. So here we go. Main reason I took the trade was the intraday rejection of the 200-day moving average and also, as I just mentioned, the V1. So I have to position size. Remember, so I see the signal, which was the intraday rejection of the 200 and the V1. Now I have to position size based upon volatility. How do we do that? So really, there's a few steps here. First of all, we have to know how much our total trading account is. And let's just say, for hypothetical sake, it's $100,000. Okay, so let's just say $50,000. $50,000. Okay, 1%. I always take 1% of the capital, total capital. So that's going to be $500, right? 1% of $50,000 is $500. Then I take that $500, I divide it by the value of the 2 ATR. ATR means it's expected to move. That's how much it's expected to move based upon the movement of the last 20 days, and then it doubles it. Right now it's 7.18. So I take that $500 divided by 7.18. It tells me to buy 69.63 shares. I round up to 70 shares. That's the correct amount of shares to buy based upon a $50,000 trading account using 1%. And now I place my emergency stop exactly $7.18 below my entry. So if it gets to my emergency stop, basically 70 shares times $7.18, there's my $500. So if it gets there, I'm immediately out. I mentioned that I wait until the end of the day to make my decisions, with one exception. The exception is if it gets to my emergency stop, then I'm out. But I know how much I've lost. I've already said, okay, I can handle a $500 loss. It's only 1% of my capital. But this does not happen very often. It only happens about 5% of the time. 95% of your losses are going to be if it closes below your end of day stop. Well, what's an end of day stop? Why did I take the trade in the first place? It rejected the 200, intraday rejected the 200-day moving average and closed above. Okay, so my end of day stop is simply a close below the 200. If it goes all the way down to my emergency stop, I lose 500. So if it just, from a logic standpoint, if it closes below the 200, like here, I'm going to lose, but I'm going to, lose $80 maybe, something like that. So 95% of the time, your end of day stop will kick in for a small loss. Even if you hit your emergency stop, it's still only a 1% of your total capital. Not fun, but you can recover from that. All right, so that's how you position size. And as I mentioned, I take partial profits if it moves the value of 0.45 ATRs from a previous day's close. So this was Friday. It's 105.09. I take 105.09. I add 0.45 ATR right now is 162. So I add 162 to the close. That would be my first profit target on Monday. Then I would take my first profit target on Monday, whatever that value is, add 162 to it again. That's my second. Then I take my second, add 162 again. That's my third. So I always have 3 standing limit orders based upon the previous day's close. And that is how I take my partial profits. So you can see on the day that I bought it here, 96.60, next day went down, but it held the 200-day moving average. So I stayed in the trade, no profit targets. The next day it moved up the value of 0.45 ATR. So I took a little bit off, reduced my position size, 10%. 10% of however many shares I have is what I take at each profit target. And I always place 3. The next day moved up big, took, I can't remember if that was 2 or 3. I know it hit 2 profit targets. It may have hit 3 profit targets. And then the orange line here, this is 1.5 ATRs above my entry. If I get to 1.5 ATRs above my entry, then in the future, if I have a close below a previous bar's close, I'm going to get out of half the remaining shares. So you see the next day it gapped up. I hit another profit target there. It did get to trailing stop, so I'm in trailing stop mode. And then here on the 3rd of October, we had our first close below the low of a previous bar, and I took off half of the position that I have. So this is just an anticipatory move to take off half, because if it heads down, I'm really glad that I took half. If it heads up, I'm still glad that I have half. Makes sense? Next day, moved up again, took some profits. Next day, inside bar didn't do anything. Next day, moved up again. Believe I hit 2 more profit targets here. Nothing. Here, hit some profit targets. Next day, nothing. On the high here, I got another profit target. And then on Friday, of course, we had the big move below. So as it moves up, I'm taking profits, taking profits, taking profits, taking profits. And using this method, if it goes way up and then comes all the way back down, you're guaranteed to have hit something by using that trailing stop. So that's why offense and defensive moves. Rejection of the 200-day moving average, intraday rejection of the 200-day moving average plus a V1, got it at 96.60, placed my trailing stop level 1.5 above, partial profits, defensive move of closing below a previous bar's low after reaching trailing stop, locking in half for a gain of 3.54%. Then we had a nice move up here, continued to take profits, and the remaining shares that I have on this trade, up nice, up 8.15%. And again, I'm only in this trade at an 8.15% gain because I've stayed in it. I gave it some breathing room. I was patient with my winners. If the very next day, if this bar here would have just closed below 200, boom, I'm just out for a very small loss. That's it. Patient with your winners, impatient with your losers. All right, so AMD, remaining shares up 8.15%. VIX. All right, well, this was a big trade for me. If you listened to the podcast last week, you heard me talk about this green area in here. And let's see, this was Friday, Thursday, Wednesday, Friday, Thursday, Wednesday, Tuesday, Monday, Sunday, Saturday. Right here, last Saturday, I talked about buying in this green area of a fair value gap. Now, what is a fair value gap? Well, kind of hard to explain it all, but first thing we need to do is we need to look for a level of liquidity that got run. Here was a low. This is considered a level of liquidity. We ran the liquidity to the downside. That's step one. Then we have to move up strongly above the first swing high, which was actually right here. So here we went into a bullish market structure, and then we moved up strongly. We left a gap, an unfilled gap from the top of this bar here to, oh, I'm sorry, that one's right here. So this here is your fair value gap. And I mentioned that if we come back into this value gap, because we are in a bullish market structure there, this is where it would get long. So level of liquidity, we ran it, we change market structure here. If we come back into the green, that is the buy zone. Well, look, right here, it came into the green, immediately rallied. And I did not take that trade, but on Saturday, I said, if we get back into the green, I will be looking for a long. Well, I did get long on Thursday because I could have got long here on Wednesday when it got into the green. I didn't take that, and then we moved down, but I did get long here on Thursday because we bounced out of the green and we also had a V1. So we changed market structure. This is the buy area. You can see right here, that was the place. The market, as soon as it got there, took off again. And I could have bought here when it just touched into the green, but I didn't. And then the next day it went down. I was like, ooh, well, I decided I'm going to wait till the end of the day. Even if it would have closed in the green, I still would have bought it. But I like this even better because we came into the gap, into the fair value gap, the green zone, rallied back out of it. Plus we had the V1, bar 1, bar 2. Bar 2 went below bar 1's low, closed above bar 1's close. That was my entry at 22.58. Okay, my emergency stop is down here. My end of day stop is halfway of the washout bar. You'll see if you watch the video on V1s, V2s, or if you study with me one-on-one in my course, that when you have a V1, depending on a V1, that a good close stop is going to be halfway of the washout bar. Well, this was the washout bar that created the V1. Halfway from the top to the bottom is right here. So my end of day stop is just simply right here, very close to where I entered it, which is correct trading. It's having your end of day stop very close so you have a good risk to reward ratio. And of course, my 2 ATR stop below here, orange line here is my 1.5 ATR trailing stop mode. And very next day on Friday, we got there. So I am now in trailing stop mode. Also, look what a large move up. I placed my 3 profit targets the next day, probably one here, one about here, and one about here. So I took off, I hit 3 offensive profit targets on this day already. So I've reduced my risk 30% on this trade already because I've taken these profits. The market can't take it away from me. And this particular trade with the remaining shares that I have, up 10.86% on one day. Pretty amazing, right? Yeah, pretty amazing. And of course, this is all having to do with the conflict in the Middle East, the VIX, and really sad situation, by the way. But anyway, this VIX trade's doing well, up 10.86%. Now, how do I manage this going forward? If it keeps moving up, of course, I will take partial profits. We're at a 60.31 RSI. If we get to a 65 RSI, then I will get out of all the position if we reject if we have a close below the 5 EMA. Alternatively, if we go up and reject the 70 RSI, then I will take off half of the remaining shares that I have. And then if we have a close below a previous bar's low after rejecting the 70 RSI, then I will be completely out of the trade. And I wanted to show you, what I'm showing you over here is the VXX, all right? This is the ETF that is the derivative of the VIX. It's basically following what the VIX is. And if we look over here at the actual VIX, which is the actual futures that are being trading, you see the black line here? This is the 200-day moving average. Anytime the VIX, is above the 200-day moving average, that is not good for the markets. So we closed way above the 200-day moving average. So this is still bearish for the markets to have VIX this high. All right. So anyway, I don't know what the VXX is going to do, but of course I know exactly what I'm going to do. If it keeps moving up, I'll take partial profits. If it rejects a 70 RSI, I'll get out of half. If we close below halfway of the washout bar on the V1 that I took the trade, then I'm just going to get out of the trade. But this is going to be very difficult for this to be a losing trade for me because I've already taken 30% off and my stop is so low. So it's a good position to be in there. So those are the 2 open trades. AMD up 8.15% on the remaining position, and the remaining position on VXX up 10.86%. Now, let's take a look at the trades that I closed out of for a loss. And again, you're going to see that these are losing trades, but the percentage loss is very small. right? I mean, I just showed you two almost double-digit winning trades because I was patient with the trades. But the losing trades, I'm impatient. So Pfizer, I bought Pfizer back here on the 9th of October. Why? Well, we had a V1. This is called a higher low V1. I really love these setups. This one didn't work, but I see bar one, bar two goes below bar one's low, closes above bar one's close. This low is higher than this low. This is a higher low V1. So I enter. I place my emergency stop 2 ATRs below. I place my 1.5 ATR trailing stop level above. And then where's my end of day stop? My end of day stop, again, if it's a V1 or a V2, is halfway of the bar, of the washout bar. Take the high, the low, halfway is right about here. As long as it closes above halfway, I'm still in the trade. And it didn't go up enough for me to take any profits. And then on Thursday, on the 12th of October, it closed below halfway. So I'm out for a small loss, 0.82%. But am I glad that I got out? Yeah, I mean, look what happened on Friday. It was down 2.46%. So, you know, taking a loss is never fun, but if you do take a loss and then the next day it goes down substantially, boy, are you glad that you took the loss. So this was a higher low V1, got in at 33.18. My end of day stop was closed below halfway, which was 33.04. Thursday, it closed below that. I just got out for a small loss of 0.82. So again, the losses you're going to see are small. Let's go to Verizon. Well, I talked about even having break-even trades, and I'll show you this was a break-even trade. But really, it wasn't break-even trade. It was a positive trade. Well, okay. So I got in here on the 6th of October. Why? Because during the day, we went under the 30 RSI, closed above the 30 RSI. That's the main signal. The add-on signals was that this line here, this gray line here, this is the negative third ATR channel. 92% of prices, when they get to this level, stop going down, move sideways, or go up. So the combination or confluences of the signals was an under 30, over 30 during the day, plus a rejection of the negative third ATR channel. Got in here at 30.76. I position size correctly. I placed my emergency stop 2 ATRs below. I placed my 1.5 trailing stop level above. So my end of day stop is what? Why did I take the trade? Under 30, over 30. So therefore, if it closes under 30 RSI, I simply get out. But there's one caveat with this trade. If I take a strictly under 30, over 30 trade and it moves 1.5 ATRs, then if it ever comes back to my entry point, I simply get out. So got in here at 30.76. Next day moved up nicely, took some profits. Next day moved up again, took some profits, got to trailing stop level. But then on Thursday, we got back to break even after reaching trailing stop level. So I got out at exactly break even. But it wasn't break even because there was some profits from here to here and here to here. Make sense? So yeah, this particular trade with the remaining shares, break even, but it was overall positive because of the partial profits that I took when the market gave them to me. Netflix, good example of getting out when you're supposed to and avoiding further losses. I got into Netflix long here on the 5th of October. Why? Intraday rejection of the 200-day moving average with a very good risk to reward ratio. So I entered, position size correctly, emergency stop 2 ATRs below. Where's my end of day stop on this? Well, I took it because it rejected the 200, so therefore my end of day stop is simply a close below that level. Next day, moved up nicely, took off some profits, reduced my position size. Next day, moved up again, took some more profits, reduced my position size. Next day down, but it held the 200-day moving average, so I stayed in the trade. And then on Wednesday, it closed below the 200, so that's my end of day stop. I got out for a loss of 1.85%, and I'm glad I did because the next day we were down, Friday down again. All right, so recap on the losing trades. Pfizer down 0.82%, Verizon break even, and Netflix down 1.85%. So I'm not always going to have winning trades, but again, just trying to make sure I get this through to you that the losses that I'm inevitably going to have are going to be small, but the winners can be large, and you need those larger winners like I had on AMD up 8.5%, 8.15%, and VIX up 10.86% to pay for these small inevitable losses. Okay, so those are the the daily trades. Let's go on to the weekly trades. Weekly trades close on Friday. Each bar is 1 week, so I wait until the end of the week to take these weekly trades. And I did get into Apple, not this week, but last week at 175.30. What was the setup? This is a setup called a return to value V2. This is the top of the value zone. This green line here is the top of the value zone. This green line here is the bottom of the value zone. Anything in this area here is considered the value zone. I don't want to buy above value. A lot of traders get caught into buying above value. I want to buy in value, sell above value, or buy below value, sell in value. So the setup was as such. We had a big run up above value, then we came back into the value zone, came back, then we went above the value zone, and then we came back into the value zone. We had some sideways motion showing that there was some stability in the trade. And then I took the trade on this V2. I've talked about V1s before, but a V2 consists of 3 bars, where a V1 consists of 2 bars. Bar 1, bar 2 goes below the low of bar 1's low, bar 3 closes above bar 1's close. So it's a return to value, sideways motion, and a V2 entry. I got in a little bit early on this one here at 173.50. I position size correctly. I placed my emergency stop 2 ATRs below, and then again on a V1 or a V2, where's my end of day stop? Simply a close below the washout bar. This was the washout bar. Washed out bar 1. High, low, close right here. So in the future now, if it closes below halfway of the washout bar, I'm simply going to get out. This week moved up nicely. I did take some profits off, and I also got to trailing stop level. So now, wait a minute. This may have been, yeah, no, I didn't. I said that and immediately felt wrong. Those were some marks that I had in my day trading on a Friday. Sorry about that. All right. Trailing stop level is going to be right about here, 1.5 ATR. So I am not in trailing stop level. I have to get here before I get into trailing stop level. But nonetheless, grateful that this trade is still positive, especially with what happened last week. This particular trade is up 1.92%. Now we do have earnings here on the 2nd. I never hold through earnings, so as soon as earnings come, I will exit the position regardless of where I am, positive or negative. But so far, so good. This weekly Apple trade up 1.92%. Gold. Excuse me, everyone. Well, this was a monster trade. I was fortunate enough to have it. But why did I take it? I took it last Friday, not yesterday Friday, but the Friday before, because we rejected the 200-week moving average. We went below it, closed above it. I got long here, 169.70. I position size correctly by taking my maximum allowed loss, dividing by the value of the 2 ATR. 2 ATR on the weekly is going to be different than the 2 ATR on the daily, right? So keep that in mind. So I took my maximum allowed, I took my account, 1% of that divided by the value of 2 ATR that told me how many shares to buy, placed my emergency stop here below. End of day stop, where's my end of week stop, excuse me, because it's a weekly bar, would simply have been a close below the 200-week moving average. Well, it definitely did not close below that. It had a monster move up. And look, I'm already in trailing stop mode. And I hit 3 profit targets on this particular trade already. Being patient because it's a winning trade. This particular trade now up 5.11% in the first week. Did I know what was going to happen? No, of course not. But I just read what the technicals were telling me, that there were no more sellers underneath this 200-day moving average. So I said, okay, Looks like the market doesn't want to go below that 200-day moving average, and it certainly didn't. So this is up 5.11%. XLF, all right, I've been in this trade for a long time. Again, what does that tell? Oops, sorry. Come on, Greg. There we go. I've been in this trade for a long time. So what does that tell you? That means it's profitable, right? I wouldn't be sticking in a long-term trade if it wasn't profitable. I bought XLF all the way back here March of this year. My gosh, been in this trade a long time. Why did I buy this? Why did I enter this trade on the weekly on XLF? Well, look, here's the 250 week moving average, the purple line. During the week, we bounced, or we went slightly under, we closed above. So the market at that moment in time was telling me that there were no more sellers under the 250. So I got long here at 30.71. Placed my emergency stop 2 ATRs below. My end of week stop would simply be a close under the 250. I placed my 1.5 ATR trailing stop level 1.5 ATRs above. Then as it moves up, I take partial profits. Next week moved up nicely. Took some partial profits. Next week, nothing. Next week moved up again nicely. Took partial profits. Now I'm in trailing stop mode. Now I'm looking for a close below previous bar's low. Doesn't happen, doesn't happen, doesn't happen, doesn't happen, doesn't happen, doesn't happen until here. This was the first close below the previous bar's low after reaching trailing stop level. And of course, I'm taking partial profits as the market moves up. Got out of half the position here for a gain of 6.4%. Then we had over a month of just moving straight up, where of course I took partial profits, took partial profits, took partial profits. Market can't take it away from me, reduces my overall risk. Then we had a month of downward movement. I stayed with it because it's staying above my end of week stop here. Then we had a little rally here, took some more partial profits off, and then here we have gone straight down. But again, am I glad that I took partial profits here? You bet I am. And this particular trade on the remaining shares that I have, up 7.50%. And then BABA, this was a losing trade, but look, we're going to have them, but the key is that we're going to keep everything small. Why did I buy Alibaba? Well, here we had a return to value and a V1. I did not take the trade here, but if I'd taken the trade here, stop is close of halfway the washout bar. This is the orange line here. I didn't buy it here, and I mentioned on the podcast that I didn't buy it, but if the next week I got a better risk to reward ratio and it still closed above half, I'd buy it. So I did get long here, 86.40, because if I'd been in this trade here, I still would have been in the trade here, so it's still okay for me to take this trade. I just got a better price. Next week went below, but barely closed above, kept me in the trade, and then of course this move was down, and it closed below halfway the washout bar clearly for a loss of 2.9%. So I got out of the trade. So those are all the trades. Just quick recap. Apple up 1.92%. Gold up 5.11%. XLF up 7.5%. Alibaba down 2.9%. So what I'm really trying to point out here is that if you see me have large percentage losses, I'm not doing my job right. I'm going to have losses, but you can see of all the daily and the weekly trades that I've shown you that the losses are relatively small or break even, and then there's some double-digit wins because I'm patient with the trades. Make sense? All right. Let's talk a little bit about trader psychology and maybe some good trading words of wisdom. This is my good friend Steve Burns from the New Traders Rich Traders channel over on Facebook. Steve's the best. He was a coach and mentor of mine for a couple of years. He's a great author. He has some wonderful books out there. Just look up Steve Byrne trading books on Amazon. I studied one-on-one with Steve, like I said, for a couple of years, and I learned a lot and really grateful to Steve. You can also follow Steve at S. Joseph Burns over on Twitter. It's worth your while. He's an amazing trader, amazing author, and whenever Steve says something, you should listen. You should read and listen. Let's see what Steve has to say here. You need a full trading system with a watch list, position sizing, and signals for maximizing gains and minimizing losses. Trading analysis alone is not a trading system. So a trading system is, hey, I need to, if it closes under the 200 and closes over the 200, that's my entry signal. Well, yes, that's a signal, but that is not a complete trading system. You need a complete trading system. What is that? Well, it's what I've been showing you for the last 40 minutes. Like Steve says, you need a watch list. Obviously, have a watch list. Position sizing. How do you position size correctly? Well, I told you earlier in the podcast, 1% of your total capital divided by the 2 ATR. That is a good mathematical formula based upon the current market volatility to position size correctly. And then you need signals for maximizing gains and minimizing losses. How do we do that? That's what I've been showing you. Having a process that allows you to stay in and maximize those gains, and also a process and the signal to quickly get you out of the trade if you're wrong, which is your end of day stop. So you need a process, everyone. Not just, oh, I buy here and it went from here to here, so I buy. That's just one little component of it. You need to know how to position size. You need to know where that emergency stop is, the end of day stop, what you do to the upside, taking partial profits. And for me, if I get to 1.5 ATR trailing stop level, then I go into trailing stop mode. And then if it reaches the 70 RSI and rejects that, I sell half. And then if we get a close below a previous bar's low after reaching the 70 RSI, then I'm out of the trade. Or if it gets to 65 RSI level and then it closes below the 5 EMA, right? This all sounds very complicated, but you need a complete process, whether you learn it from me or whether you learn it from someone else. Everyone, if you're serious about trading, you have to have a complete process. You need to have if-then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. You can't just shoot from the hip because I felt it, right? Unless you're psychic. And if you are legitimately psychic, please contact me. We'll make a lot of money, right? But barring someone being absolutely and certifiably psychic, you need to create a trade that has a good structure with a good risk to reward ratio that shows that a level is being rejected, and you need to know what to do, whether it goes down or it goes up. I've been trading for 28 years, and everything that I use in my trading and everything that I teach, every single rule, there is a reason for it, and that's what you need. So thank you, Steve Burns. Please do yourself a favor, follow Steve Burns over on Twitter at @SJosephBurns. Or you can follow him also at New Trader, Rich Traders on Facebook. All righty. Let's take a look at what's going on with the setups that I have, the potential setups I have for next week. And then after we go through the potentials for daily and weekly, we're also going to kind of look at the markets in general, which I find helpful, big picture of whether I'm going to take a trade on an individual stock, looking at, it's important that you look at the large drivers of the market, looking at the S&P, looking at the Qs, looking at TLT, looking at the dollar, looking at VIX. These will all give you clues on what the general market is doing. So after we go through the potential setups that I have on the dailies and weeklies, we'll look kind of big picture at the markets and gold and the dollar and the VIX and bonds, the true drivers of what's going on big picture in the market, okay? First of all, let's look at Boeing, BA, on the daily. Okay. Well, there's nothing here at the moment, but what really jumps out to me on Boeing, and actually a lot of the different markets that we're going to look at, is we have some potentials for some double bottoms, bullish divergences. I studied one-on-one with Dr. Alexander Elder, amazing trader, amazing author, and a double bottom bullish divergence is his favorite technical signal in technical analysis. So let's start. What is a double bottom bullish divergence? Well, a double bottom is pretty easy to figure out. You can see we have a bottom and we don't quite have a bottom, but in the future, if we get down and test this bottom or go lower, then we'll have a double bottom. But the key here is what's going on with the MACD, and the MACD is a momentum indicator. This is the red bars here. The more these red bars go down, the stronger the downward momentum. And you can see we move down here like almost nonstop, and lots of red bars. Well, the first rule is that you need to have a bottom with deep red MACD bars. Well, we obviously have this. Then you need a rally, and you need the rally to have the MACD bars go green, which certainly they did. Then you need to come back down, and you need to test this low, the first low, or go lower. And then you need to take a reading on the MACD bars, how red they are. Well, look, we are almost at this, we almost have a double bottom within, I don't know, a couple dollars. Next week, if we do go back down and test this bottom, look, there's no red here whatsoever. What does that mean? Well, it means that even though we've had this significant down move, from a MACD perspective, we don't even have enough downward momentum to make this green. This is almost a double bottom bullish divergence with a missing right shoulder. The red is the first shoulder, but we have no shoulder here. We have no red. This is very bullish. This looks extremely bearish, doesn't it? It looks extremely bearish, but from a double bottom bullish divergence, and in this case, missing right shoulder perspective, all this means is this move down here from a MACD perspective was not as strong as this move. And the implication of this is that we are running out of sellers. And if we run out of sellers, the implication is we are going to go up. When a market runs out of sellers, that's when it moves back up. So we almost have a double bottom bullish divergence, missing right shoulder. So big picture, this is very bullish, but we still need a signal to get us into the trade and give us a structure to have our end of day stops and emergency stops, all that kind of stuff. So what I'm looking for, look, from a deep dip buy perspective, and again, this is one of the strategies that I teach in my online courses and my private courses, that is deep dip buy. We're at 31.11, so we're very close to possibly rejecting the 30 RSI. Whether we go underneath the 30 RSI during the day and then close back above it, that would be an intraday rejection of the 30 RSI, or simply if we close under the 30 RSI and then close over the 30 RSI. So I'm going to be watching Boeing carefully, BA, next week, because this double bottom bullish divergence, big picture, is very bullish, but I just need a signal, and my signal would be intraday rejection of the 30 RSI, or a close under the 30 RSI, close over the 30 RSI. In addition to that, so I've talked about double bottoms, bullish MACD divergences. There's some other divergences going on here as well. ATR divergences. What's that? Well, look, at this low, we were at this is the -1, -2, -3, -4 ATR channel. So now we're almost equal to this low, but look, we're only at the -2 ATR channel. So here we're at the -4, here we're almost as low, we're only at the -2. This is called a ATR divergence. And in addition to that, we have something called an RSI divergence. Look at this low here. Look how low the RSI level was. And now we're almost as low. Look how high the RSI. So this is the trifecta of divergences. MACD divergence, RSI divergence, ATR divergence. This is very bullish. Doesn't look bullish, does it? But it's very bullish big picture. But again, we still need the entry signal, which for me would be an intraday rejection or a close under, close over 30 RSI. So that is what I am looking for. And hey, by the way, If you find this video, if it's helpful, if you find some value in it, if you wouldn't mind just hitting the thumbs up button for me, I would really appreciate that. It helps to build the channel, helps keep the channel around, lets YouTube know that there's some valuable content here. So always forget to mention that in the podcast, but I remembered. So if you wouldn't mind, I would really appreciate it. So this looks very bullish to me. I'm just waiting for a signal. Rejection of the 30 RSI next week. I would potentially take this trade. DIA, the Dow. So the Dow has held in there pretty strong. It was actually up on Friday, and there's quite a divergence between the Dow and the Qs and the SPY and the Russell 2000. The Dow stocks, probably because they're the, historically the stronger kind of stocks, they're performing well. So what I'm looking for on the DIA next week, ideally, a move down and rejection of this 300-day moving average. That would be ideal. If it closes above the 200-day moving average, I could also use that as an entry. So if it goes lower and rejects the 300-day moving average, I would consider taking that. If it goes higher, closes above the 200-day, then I can use the 200-day as my entry. Okay? Russell 2000. Okay. This is the Russell. You can see very weak, but look, we're very close to a double bottom bullish divergence. Here's the low, deep red MACD. We rally into green, and we're almost coming here to test this low or go lower. And again, no red. This is beautiful. Double bottom, bullish divergence, missing right shoulder, but I still need a trigger under 30, over 30 is what I'd be looking for. Pfizer. Excuse me. Okay, well, I had a losing trade that I got out of on Thursday of Pfizer for a loss of 0.82%. But again, double bottom bullish divergence. Look at the low here, deep red. We rallied into green, obviously. Now we're very close to testing this low, and we're very close to an under 30, over 30. So kind of a theme in what I've been showing you here, both on Boeing and the Russell and Pfizer. So what I'm looking for simply next week on Pfizer would be a rejection of the 30 RSI in the context of the double bottom bullish divergence. We also have RSI divergences. Again, we also have ATR divergences. So these are some really good potential setups. I just need the trigger. And by the way, well, I'll mention that in a minute. Shopify. Okay. Well, again, double bottom bullish divergence. Here's the low, very red, rallies into green. Now we almost are testing the previous lows. No red whatsoever. Very, very strong signals. But I need a signal. What's my signal? Well, on the other ones, Boeing and Russell and Pfizer, I was looking for an under 30 over 30 or some kind of rejection of the 30 RSI. But on Shopify, I have another option here. We're not really close to the 30 RSI. Look at this 250-day moving average. If I got an intraday rejection of the 250 or a close under, close over, especially in the context of this double bottom bullish divergence, missing right shoulder, very bullish as well. So kind of a theme with everything I've shown you. Boeing, double bottom bullish divergence, looking for rejection of the 30 RSI. Dow, a little different because it's stronger, looking for potential of the 300-day moving average, or if it goes higher, close above the 200-day moving average. Russell 2000, double bottom bullish divergence, missing right shoulder, looking for an under 30 over 30. Pfizer, exactly the same, double bottom bullish divergence, looking for rejection of the 30 RSI. And Shopify, a little bit different, double bottom bullish divergence, looking for rejection of the 250. Now, I do want to point out that it's, if we move down on Monday and then have a big rally back up, almost all of these 5 symbols could trigger. Does that mean I would take all 5 signals? No, it does not. I would have to narrow it down to the very best one because I only like to buy one market on a particular time frame, the best one. Well, what's going to be the best one? It's going to depend a lot on the risk to reward ratio. One may have a better risk to reward ratio than the other. It also will depend on how many signals I have. Maybe some of these I'll have an under 30 over 30, but others I'll have an under 30 over 30 with like a possibly a V1 or something, right? So that one would, an under 30 over 30 with the V1 or V2 would be better than just an under 30 over 30. That one would have a higher chance of being a profitable trade. I would also have to look at what's going on the weekly charts on the higher time frame to see if there's some kind of rejection of a key level on multiple time frames, not just one time frame, and then which one has the best risk to reward ratio. So it's not that easy. Right? You can't just look at one little signal. Dr. Alexander Elder, when I studied with him, says, Greg, you need confluences, combinations to take money out of this market. Usually one signal is not enough. You need multiple signals on multiple time frames to put you in the best position to have a positive trade. And again, this is what I teach in my one-on-one private course, and I'll drill it into your head. So again, my contact information is in the description of this YouTube video. All you have to do is reach out to me. So, all right, those are the dailies. Real quick again, Boeing, rejection of the 30 RSI with the double bottom bullish divergence, I would consider. Dow Jones, looking for either two options, rejection, preferably I would like to look for it to go lower, look for rejection of the 300-day moving average, or if it closes above the 200 to the upside, that would also be potential. Russell 2000, this one's very simple, under 30 over 30, rejection 30 RSI. Pfizer, rejection at the 30 RSI, especially in the context of the double bottom bullish divergence. And Shopify, a little bit different, looking for a rejection of the 250. Also, possibly if we rally above the 200, if we go up and rally above the 200, then we would have a close under, close over the 200, and we'd also have a V2, right? So that would be the confluence there. But ideally, and the weekend futures are down right now. Who knows what's going to happen? But this 250 is what I'm looking for. But as an alternative, close above the 200. All right, let's go to the weeklies. All right, Home Depot. Well, what sticks out to me right here is the 200-week moving average. If and only if next week we move down and either bounce at the 200-day moving average or go under it during the week and then close back above it, that would set up a good structure for a good risk to reward ratio based upon the 200-day moving average. And whenever I'm looking at buying off lower at a major moving average below me, I always like to look in the past to see whether or not that level was respected. Well, look, was it respected? Almost to the penny. Almost to the penny it got there, and then had a several month bounce off the 200. Does it mean it's going to happen here? I don't know, but I will definitely consider getting long Home Depot if we come back down, bounce at the 200 with a good risk to reward ratio, or gives me a good intraday rejection of the 200 as well. If I do take that trade, earnings are here on the 14th of November. Again, I never hold through earnings, so even if I take the trade, I will get out before earnings are announced. Okay, so some kind of rejection of the 200-week moving average here is what I'm looking for on Home Depot. And look, to buy a quality company like Home Depot at a major moving average with a good risk to reward ratio does not mean it's going to be a positive trade. But if you go back in time, anytime you've bought Home Depot near the 200 with a good risk to reward ratio, more times than not, it's worked out. Doesn't mean it's going to be this time, but we never know, right? Johnson & Johnson, again, not this week, but the week before, we bounced at the 200 and we had a V1. That would have been a legitimate trade. Would have been slightly down on this trade. But next week, we have earnings. So I'm not going to buy it into earnings because it's so close. But after earnings, if it did reject the 200-day moving average after earnings, then I'd be very likely to take the trade. And again, in the past, did it respect the 200-day moving average? Yes, it did. Will this time? I don't know. But it sets a good precedent, and you're more likely to have a positive trade if it has respected it in the past. Of course, with what's going on in the Middle East, it could change everything in the market. So, I'm not saying this is going to work this time, certainly not, and especially with the variable of the Middle East conflict right now, we could go much, much lower. We could go much, much lower. So please keep that in mind. Just go off of what the technicals are telling you. If the market rejects the 200, closes back above, then the market's telling you there's no more sellers under the 200. Last but not least, XLF. Okay, I am already in XLF, as you know, from the 250 way down here. But I am going to consider to get back into XLF with the full position. I don't have a full position now because of all the profit taking I've taken here and the trailing stop level triggers and so forth and so on. This would have been a legitimate trade last week because we rejected the 200 and closed back above. So next week, if we go back down, I didn't like the risk to reward ratio because this is quite far above the 200-week moving average. But next week, if we go back down and we test the 200-week moving average again and it gives me a better risk to reward ratio, then I will go into a brand new trade. I'm already in the trade, but again, I've scaled out, trailing stop levels, all that. So I don't have a lot of shares left. So next week, if we do reject the 200-week moving average, I'll just morph it from the old trade into a brand new trade, everything based upon the 200-day or 200-week moving average. So, okay, real quick recap. XLF, if I get it, I'll potentially get into the trade if we have on the weekly, if we have a rejection of the 200, that's a possibility. Johnson & Johnson, if we have another test of the 200-day moving average after earnings, or 200-week moving average, excuse me. And then on Home Depot, earnings are out a few weeks. So if we get a rejection of the 200-week moving average. So, okay, as I mentioned, let's take a look at the markets in general, just to kind of get an idea of what's going on here. Okay, here are the cues, and you can see here's a trend line by connecting two lower highs here. You can see out into the future. Here's the high pivot point. Here's the pivot point. We've gone out into the future. Do you see how the market tried to get above that trend line and close back below? So now this trend line above is going to act as resistance for sure. And then you connect the bottoms here. Do you see how we have a trend line to the downside? So if we get back up into this level here for some reason, that's going to be resistance. And if we come back down to this trend line that goes out in the future, that should be some kind of support. So you can see we're kind of narrowing the prices in between here and here. We're going to narrow. And I can promise you, if you narrow, that you're going to bust out either to the downside or to the upside strongly. I just don't know. Unfortunately, I don't know which way that's going to be. But following these trend lines is pretty good. Again, if we move up here, this is going to be resistance. If we move down here, this is going to be support. So I think we're going to be coiling in here and waiting for either a big move up, big move down. Historically, we are in, from a seasonality standpoint, we are in not the best market, the best month right now, October. But historically, seasonally, November and December are better. So it'll be interesting to see if we can make a solid break above here or to the downside, solid break below there. That will probably show you where we are going. SPY, of course, here's the trend line to the resistance to the upside. Here's the high. Here's the high. Moving up here, this is going to be resistance and tougher to get above. Where's the support? We don't really have a trend line to the downside, but we do have the 200-day moving average, which would be some potential support. Let's look at bonds. Of course, bonds, the direction of bonds is more than likely going to tell you the direction of the market. This is TLT. We've been going down, 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 down on the price. Well, as TLT price goes down, yield goes up. Higher yield's not good for the market. You can see over the last week or so, we've had a bit of a rally in bonds, which is positive for the market. But again, because of the Middle East conflict, that's really what's driving. If it wasn't for the Middle East right now, we most likely would be moving higher. But then again, that's probably this conflict in the Middle East and the volatility of that is what's driving money into bonds as a safety play. But you can see here the trend line to the downside. So to the downside, there's going to be some support here on TLT. Here's the long-term trend line above, which would be resistance. So again, everything's still kind of coiling, waiting for a resolution. UUP, which is the dollar, essentially not all the time, but right now, the higher the dollar moves, the more likely the market's going to go down. But what I'm seeing forming here on UUP is potential double top bearish divergence. Here we have a high, green MACD bars. We move down to red. Even if we come up here and challenge this high, most likely we're not going to have any green bars, which is very bearish for the dollar. And if it's bearish for the dollar, it's probably bullish for the market. So I'm seeing a bit of a rally in bonds. I'm seeing this double top bearish divergence in the dollar. To me, that's going to be bullish for the market. And then we'll look at gold. Of course, gold had this huge move up because of this Middle East conflict. That is kind of bad for the market. And then if we look at VIX right now, of course, I took this trade, but right now the VIX is elevated because of the market volatility. And again, if we look at VIX, we are above the 200-day moving average, which is kind of bullish. So there's really a lot of mixed signals here on the market. Some are bullish, some are bearish. And of course, we have this Middle East situation going on. So it's a dicey situation right now. So follow your signals. Don't try to anticipate the market. Let the market, from a technical standpoint, tell you what is going on. So anyway, hope that is helpful, everyone. As I mentioned, I do teach private one-on-one lessons in the evening time, 15-hour course. I love to teach. I've had students from all over the world, from very beginner to top-level hedge fund managers. I'd be happy to work with you too. You're going to learn a lot. I'll teach you everything I know. So my email is in the link in the description. If you like if you like online courses, I have a very good online course available at udemy.com where I teach you step-by-step how to trade the deep dip by stock trading strategy. I've sold so many of these around the world, so many good reviews, so much good feedback. It's very affordable, only between $12 and $15. And the link in the description. The link is in the description of this video here. It's not as good as the one-on-ones, because in the one-on-one course I teach you all 5 trading approaches. But it's a good place to start, and it's very, very affordable. And then, as I mentioned before, if you like the podcast today, if you found some value, I would appreciate if you could hit the thumbs up button. And then, as always, most importantly, last thing I'll leave you with: please try to go out and do something nice for someone today. If we all went out and did one nice thing for another human being today, it really would make the world a nicer, better place. And if you could also go out and do one nice thing for an animal today, trust me, I was raised with so many animals. They appreciate acts of kindness just like we do. And so if we could do one nice thing for another human today, if we could do one nice thing for an animal today, it really would make the world a better place for all of us. So anyway, that's it for this week. Hope this was helpful for you. Hope you learned something. If you have any comments or questions, I do my very best to answer them. Just put them in the comment section below. And God willing, I will see you next weekend. I hope you enjoyed the rest of your weekend. Get some rest, do some chart study, and how about doing some deep breathing as well. So again, thanks everyone for coming by here. Appreciate you spending your time, investing your time. And like I said, hopefully I'll see you next week. All right, on the way out here, I have to run the U.S. legal disclaimer. Thank you so much, everyone. Take care, and thanks for being here.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large reward, risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact